Hi there, I Tab the Soul here with Velocity Real Estate. In this video, we're going to talk about whether real estate prices are actually falling. Well, you know what? Most of us think of real estate as an appreciating asset, and most of the times it is, mainly because we're accustomed to real estate increasing year over year at a modest rate, not at a drastic rate. Only in the recent past have we seen drastic increases in a short amount of time. I mean, don't get me wrong, we've all seen that neighborhood that opens up, catches on fire, and within a short amount of time, they're selling for 100,000 more, and we're thinking, why didn't I buy in there? Well, that's a micro market and topic of another video we've already done. But normally, here's what we see. We see someone buy a house for 300,000. Within 5 years or so, that house is worth about 360, and we're happy about it. But now imagine what would have happened if that house had been worth 360 the very next year after you bought it. Well, that's what happened for all of us in 2021. We saw a huge gain in our house value within a short amount of time. But is that something that's really sustainable year after year after year? Well, no. I mean, for most of us, if our house prices realistically did that, we couldn't afford our neighborhoods in a matter of a few years. But does that mean that because prices aren't rapidly accelerating, that they're falling? Well, I don't think so. I would prefer to use the word moderate or level out. What I want you to know is that in real estate, there's a difference between depreciation, which means rapidly falling prices, and deceleration, which means that prices are still increasing, but just not as fast as they once were. I mean, think of it this way. If you're driving, let's say you're on the downtown connector and you need to get around that dreaded 18-wheeler, so you rapidly accelerate to get past it. But now you need to slow the car down again, but everybody around you is still going 70 and 80 miles per hour. There's two ways to do it. One, press the brakes hard till you get back down. Or two, simply take your foot off the accelerator. Well, most of us hate the driver that does number one and does the hard brake, because it's harder to steer a car when it's either rapidly accelerating or decelerating. But by simply taking your foot off the accelerator, you slow the car down, but you're still going at a pace that allows you to keep up with traffic, and it's more predictable for you to steer. Well, the same thing is happening in our current real estate market. You see, the market of 2021, last year, really the last year and a half, was accelerating so fast that sometimes it became downright unpredictable, which is why it took multiple offers over months for some people to acquire a home. So what's happening now is that while we are slowing down, it's still not enough supply in the market to substantiate the fact that we would put the brakes on and that prices in turn would fall drastically. You see, thanks to interest rates, demand has cooled off, the general public has taken their foot off of the accelerator, and so prices are cooling down or leveling off. But what happens in the market is that things just become a bit more predictable. So whether you're thinking about selling or buying in this market, I want you to remember two things. When it comes to prices, there's depreciation, which means that prices are falling fast, and that's not what's happening right now. But there's also deceleration, which means that prices are leveling off. They have been rapidly accelerating, but now they're just accelerating at a much slower rate. Imagine, last year we saw price gains in 2021 of 20% on average across the metro area. This year, they're still thinking price gains will happen in the low double digits, 10 to 14%. So if you're thinking about buying or selling a house, it's still a good time to act. Well, that's real estate advice from your real estate friend, Itanda. See you on our next video.